Want to make money? Fast? Every day? Of course you do. Everyone wants a piece of the action. The stock market is a jungle. It's exciting, it's dangerous, and it's full of opportunities to make a killing. You need the right tools, the right instincts, and the right strategy to survive. That's where SPY options come in. SPY options are like the Swiss Army knives of the stock market. By the time you're finished, you'll be a lean, mean SPY options trading machine. Ready to rumble? Let's do this. First things first, what exactly are SPY options? SPY is an ETF that tracks the S&P 500, a basket of the largest US companies. When the S&P 500 goes up, SPY goes up. When it goes down, SPY goes down. Options are contracts giving you the right to buy or sell SPY at a specific price before a specific date. SPY options are popular among day traders because they're liquid and low cost. They offer exposure to a wide range of stocks, helping to diversify your portfolio. The real beauty of SPY options lies in their leverage, allowing you to control a large number of shares with a small amount of capital. Alright, let's break down these SPY options. Imagine you're a general, and options are your weapons. You've got two main types, calls and puts. Calls are like your offense. You use them when you think the market's going up. Puts are your defense, your shield when you expect a downturn. Each option contract represents 100 shares of SPY. You pay a premium for the right to buy, with calls, or sell, with puts, at a specific price. Options have an expiration date. If SPY moves in your favor before the option expires, you profit. It's a high-stakes game, but that's what makes it so exhilarating. Let's say you're bullish on SPY. You'd buy call options. When you buy a call, you're betting that SPY will rise above the strike price before the expiration date. If it does, you can exercise your option, buy those shares at the lower strike price, and then sell them at the higher market price for a profit. Now, let's say you're bearish. You'd buy put options. Puts give you the right to sell SPY at the strike price, even if the market price drops below it. So, if SPY goes down, you can buy the shares at the lower market price, and then exercise your put option to sell them at the higher strike price, locking in your profit. Options trading involves understanding concepts like time decay and implied volatility. But the basic principle is simple. Buy calls when you're bullish. Buy puts when you're bearish. The allure of SPY options. Why traders love them. SPY options are traded on the most liquid options exchange in the world, the Chicago Board Options Exchange, or CBOE. That means there's always a ton of action, making it easy to get in and out of trades quickly. SPY options are incredibly versatile. You can use them individually or combine them in a multitude of strategies to profit from different market conditions. SPY mirrors the S&P 500, offering a broader market view than just betting on a single stock. In essence, SPY options offer a potent cocktail of liquidity, versatility, broad market exposure, and leverage. All right, listen up. If you want to conquer the SPY, you gotta learn to read the market like a hawk. I'm talking about charts, baby. Charts are your roadmap to success, showing you where SPY has been, and more importantly, hinting at where it might be going. First things first, ditch those fancy, complicated charts with a million lines and indicators. Keep it clean, keep it simple. A basic candlestick chart is your best friend. It'll show you the open, high, low, and close prices for a specific period. Green candles usually mean bullish. Price went up. Red candles mean bearish. Price went down. You gotta look for patterns, for trends. Learn to read that story, understand the sentiment, and you'll be one step ahead of the game. Those candlesticks aren't just pretty pictures, they're talking to you. A long green candle? Bulls are in control, pushing the price up. A long red candle? Bears are dumping, sending the price lower. Short candles with small bodies? Indecision, a tug of war between buyers and sellers. Look at the wicks, those thin lines sticking out of the candles. Long upper wicks mean buyers tried to push higher but got rejected, a warning sign. Understanding candlestick patterns and trend lines is like learning the SPY's secret language. Section 3. Support, resistance, and breakout plays. Support and resistance levels are crucial zones on a chart. Support is like a safety net, a price level where buying interest tends to overcome selling pressure, preventing further price drops. Resistance is like a brick wall, a price level where selling pressure often outweighs buying interest, halting further price advances. Breakouts are your cue for action. A breakout above resistance suggests increasing buying pressure and a potential move higher. Remember, not all breakouts are created equal. Look for high-volume breakouts, confirming strong conviction behind the move. Section 4. Technical indicators. Your SPY secret weapon. Charts and candlesticks are great, but sometimes you need a little extra firepower. That's where technical indicators come in. One of my favorites is the Relative Strength Index, or RSI. It measures the strength of price changes to evaluate overbought or oversold conditions. Another go-to is the Moving Average Convergence Divergence, or MACD. It's a trend-following momentum indicator that shows the relationship between two moving averages of SPY's price. Use them in conjunction with your chart analysis and risk management strategies for optimal results. Section 1. The Art of the Trade. Strategies for SPY Options Domination. Alright, you chart-reading warriors, you're ready for the main event, SPY Options Strategies. Remember, options are versatile. They're not just about betting on whether SPY goes up or down. You can use them to profit from volatility, time decay, or even just range-bound trading. Now, let's unlock the arsenal and equip you with the knowledge to become a true SPY options strategist. Feeling bullish on the SPY? Think the market's about to take off like a rocket? Then you need a strategy that captures that upward momentum. One classic play is the long call. You're buying a call option, betting that SPY will rise above the strike price before expiration. If SPY soars, your profits soar too. But maybe you're not looking for the moonshot. Maybe you just want to profit from a steady climb. That's where bull call spreads come in. You're simultaneously buying and selling call options at different strike prices, creating a defined risk and reward profile. Remember, bullish strategies are like riding a wave. You need to catch it at the right time and ride it to profit. Section 3. Shorting the dip, bearish strategies for downward moves. Sometimes, you gotta embrace the darkness. When the market's looking shaky and fear is in the air, it's time to unleash your inner bear. The simplest bearish play is the long put. You're buying a put option, betting that SPY will drop below the strike price before expiration. The lower SPY goes, the higher your potential profit. But maybe you're not convinced it's a full-blown crash. Maybe you just anticipate a short-term dip. Remember, bearish strategies are like navigating a minefield. You need to be precise, calculated, and always aware of the risks. Section 4. Straddling the market, neutral strategies for uncertainty. Sometimes the market's like a roller coaster, up, down, and all around. In these volatile times, you need a strategy that can profit regardless of the direction SPY decides to take. That's where neutral strategies, like long straddles and long strangles, come into play. With a long straddle, you're buying both a call and a put option with the same strike price and expiration date. You're betting on a big move regardless of direction. The larger the price swing, the bigger your potential profit. A long strangle is similar, but you're buying a call and a put option with different strike prices, one above and one below the current SPY price. This strategy is cheaper than a straddle, but requires a larger price move to be profitable. Remember, neutral strategies thrive on volatility. The more SPY swings back and forth, the higher your chances of success. But if SPY stays range-bound, you could lose your premium. Choose wisely, my friend. Alright, let's paint a picture. You're watching SPY like a hawk. It's been trading in a tight range for days, forming a symmetrical triangle pattern on the chart. The bulls are pushing, the bears are pushing back, but neither side is giving an inch. Tension is building, and you can feel it in your gut. A big move is coming. Then, boom! SPY breaks out above the upper trend line of the triangle, accompanied by a surge in trading volume. This is it, your signal to strike. You quickly buy to open 2 call options contracts with a strike price slightly above the breakout point. Why 2 contracts? Because you're feeling confident, but you're also managing your risk. The next day, SPY continues its upward momentum, climbing another 2%. Your call options are now deeply in the money, and your profit is looking sweet. You could hold on for more gains, but you remember my golden rule. Bulls and bears make money, pigs get slaughtered. You decide to lock in your profits and sell to close your call options, walking away with a tidy sum. Remember, knowing when to take profits is just as important as knowing when to enter a trade. This, my friends, is the power of options trading. By correctly identifying a bullish breakout and utilizing the leverage provided by call options, you were able to turn a relatively small price move in SPY into a significant profit. But remember, not every trade will be a winner. That's why risk management is crucial. Always use stop-loss orders to limit your potential losses and protect your hard-earned capital. Now, let's flip the script. The market sentiment has shifted. SPY has been in a steady downtrend. SPY is testing a support level. Volume is heavier, showing signs of weakness. You buy put options below the support level. SPY gapped down overnight, breaking support. Your put options are now printing money. You sell to close, locking in a substantial profit. This is how you profit from a bearish breakdown. Let's face it, the market can be a fickle beast. Sometimes it's up, sometimes it's down, and sometimes it just likes to move sideways. But fear not, my fellow traders, for there's a strategy for every market condition. When uncertainty reigns supreme, it's time to unleash the power of the long straddle. Imagine this, a major economic announcement is looming, or perhaps an earnings report from a market-moving tech giant is about to drop. The outcome is anyone's guess, and the rumor mill is working overtime. Traders are on edge, and the options market is buzzing with activity. This, my friends, is the perfect environment for a long straddle. You decide to buy to open 1 call option and 1 put option with the same strike price and expiration date, straddling the current SPY price. You're not betting on direction, you're betting on volatility. You believe that regardless of whether the news is good or bad, SPY will make a significant move in one direction or the other. You're ready to profit from the chaos. The announcement drops, and the market goes haywire. SPY surges higher, breaking out of its recent range. Your call option is now in the money, and your profit is climbing rapidly. You could hold on, hoping for an even bigger move, but you decide to take your profits and run. You sell to close both your call and put options, locking in a nice gain. Remember, the long straddle is a volatility play. It's not about predicting direction. It's about capitalizing on uncertainty. The larger the price swing, the greater your potential profit. However, if SPY remains range-bound, you could lose your entire premium. Use this strategy wisely and always manage your risk. So there you have it. You've stepped into the ring, gone toe-to-toe with the SPY, and come out swinging. We've covered the basics, the strategies, the examples. You've got the tools. Now it's time to build your trading empire. Remember, SPY options trading isn't a get-rich-quick scheme. It's about discipline, strategy, and a whole lot of guts. Don't be afraid to take calculated risks, but always manage your bankroll like a hawk guarding its nest egg. Keep learning, keep practicing, and never stop adapting to the ever-changing market landscape. The more you understand, the better your instincts become. Trust your gut, but let logic guide your hand. Now go out there, be bold, be daring, and make some serious noise in the SPY options pit. The market waits for no one, and neither should you. Hold your horses, champ. Before you go all in, remember, the SPY options arena is littered with the carcasses of unprepared traders. Don't become another statistic. Here are a few pitfalls to avoid on your road to trading glory. It's a trader's worst enemy. Don't let winning streaks cloud your judgment. Stick to your plan, take profits when they make sense, and never chase losses like a dog chasing its tail. The flip side of greed, fear can paralyze you into inaction. Don't be afraid to pull the trigger when you see an opportunity. Hesitation can cost you profits. Slow and steady wins the race. Don't feel pressured to trade every tick. Pick your spots carefully, like a sniper waiting for the perfect shot. Trading without stop-loss orders is like skydiving without a parachute. Exhilarating, but potentially disastrous. Always protect your downside, no matter how confident you feel. The market is a jungle, my friends, full of tempting opportunities and hidden dangers. Stay vigilant, stay disciplined, and most importantly, never stop learning. The more you know, the better your chances of survival and, ultimately, success.